should we buy or sell the agency bond ETF? First off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So we have the agency bonds ETF here. It is composed of bonds from various government agencies. 1.57% away from the 52-week low here, but we are, 7-ish% away from the highs. So let's look at the charts. So these are weekly data points. This is, big picture. And we can see that price very recently fell to a very interesting long-term level. So let me just draw that in here with my handy drawing tool. So let me just get it like this. So you can see that this horizontal level, it was where we just bounced from. So it is a support level that goes all the way back here to 2013. Was also very relevant here in later 2018. So it's obviously is a level that it matters for the market. Apparently, the market thinks that there's great value at this level. When we look at the previous times, we bounced from that level like this here. Then we got a maximum 6.73% move, which is pretty substantial, in the bond market. During this rally here, we did get 13%, which is pretty significant. So this looks interesting. When we go here to the daily data points, one of the key things here is this green 50-day moving average. So it is a pretty big deal moving average level. It was used very aggressively here by the short sellers. Here as well, the interesting thing is that the 50-day moving average is now turning into a potential support level. So we have it, around 3 days here of staying above it. So it is very important now going forward that we stay above that key level. When we go here and look at these other indicators, we see that, we recently, come from, a very oversold level. So this ETF was just very suppressed, extreme bearish sentiment. And we also see this reflected in the PPOs, which measures the difference between price and the various moving averages here to the left. And the colors, of course, correspond. Looking at the daily data points, a very strong rise here in RSI, but even though we have seen a meaningful move here in price, we are not at RSI or PPO levels that are like major risk in terms of pullback yet. We see that historically we can be meaningfully higher until it. Yeah, so basically, even though yes, we have seen a meaningful move so far, there could be more fuel left in this move. So going here into the laboratory, I think the line in the sand is 500 DMA support. We have recently reclaimed that key level, and the expectation now is that the bulls will be able to protect it. If they are not able to continually attract buyers at that level and stay above it, then that will be a sign that this could basically just be a bounce. So meaning it's not like a longer term low for this ETF, but obviously it's to be determined. I think that at this point, I think I will give the bulls a decent, 4. Here we have the seasonality for a GSAT. Looking here to the right, we do get the average performance. We do see that there usually is some weakness here into the 6th of June, but that is when the seasonality gets very, very strong, leading up into the 8th of July. So yeah, bullish seasonality on average. Looking here to the left, then we can see the difference between how often it closes higher than it opened, and also the average performance. So over the last 5 years, You can see that June is extremely bullish. It closes higher 100% of the time. July and August are also strong months. Over the last 10 years, June, 67% chance of it closing higher than it opened. What's even better is that July, it closes higher 78% of the time. So the coming month and the month after that is very strong. And you can see that May, and there's still some days left of May, it closes higher 90% of the time. The last 15 years, May is extremely strong, June is decent, and then July is the second strongest month. So I think that the seasonality here for this ETF it's very good. The current month is good, and the coming 2 months are very strong. So if I was a short seller, I would really not be attracted to putting on short positions on this ETF. So I think I will actually give the bulls a 7 here. This is very good seasonality. Let's look at the fundamentals. So I am comparing the AGG, which is the US Aggregate Bond ETF. So it's more diversified bond ETF with, of course, the AGZ, the one we are looking at specifically. So first off, the expense ratio here there's a huge difference. So 0.03 and 0.20. So let's just quickly calculate that difference. When it comes to expense ratios, they are especially a big deal when you look at ETFs that track securities that move in smaller percentages. And the bond market is not where you usually see like double-digit and triple-digit moves, which means that given that there's a 567% difference here in expense ratio, I would certainly say that the AGZ is a bit it's pricey. Okay, let's look at a bit at the performance. So year to date, you can see that the AGZ, it has fallen less than the AGG. Looking at the yield, 1.77% versus almost 2% here for the AGG. So let's look a bit here at the holdings. So the AGG, it has 10,255 holdings versus the mere 62 here from the AGZ. So you can see like the government of Israel here. Then we have Tennessee Valley Authority, Federal National Mortgage. Yeah. So it's a bit surprising to see government of Israel here. So here you can see the difference between AGG and AGZ. You see that sovereign bonds is definitively a very substantial part of the AGZ, while AGG is more diversified. When it comes to the diversification, there is this general assumption that being diversified is inherently better than not. When it comes to your overall portfolio, then it certainly is very beneficial to be diversified, meaning you have various positions that do not correlate too strongly with each other. When, however, you pick ETFs, if you systematically always pick the most diversified ETF, then you run the risk of building an overall portfolio where, because of the substantial diversification within each ETF, you end up with a portfolio that actually is very intercorrelated. Okay, so in terms of the fundamentals here, I think that the biggest issue with the agency bonds ETF is definitively the expense ratio. So taking all things together, I do think I will give this one, I will give it a -2. There were some good things about this ETF versus the alternative or the primary alternative, but also, some downsides. So let's look at some correlations. So here we have long term, -23% here with the S&P 500, 96% with the AGG. Then we have -97% here with the 10-year Treasury, the 10-year yield, and then you do have minus 51% with the dollar index. Short term, 77% with the total stock market ETF, the WT, and then you do have 76% here positive with the S&P 500. Almost perfect correlation with the AGG, meaning they do basically move together. And then you have minus 98% with the 10-year yield, so very strongly negative correlation, and then minus 91% here with the dollar index. Okay, so looking, short and long term, I think it would be very interesting to have a bit of a look here at the 10-year yield. Let's do it like this, 10I. Here we got, the United States 10-year yield. It's been a huge topic because we've seen a very substantial move here in the 10-year yield. So let me draw in here because there might be some decent time cycles. Yeah, interesting. So if you look at this, like this time cycle here is pretty clean and it peaks around the middle, then we do get the declining phase. Here it peaks a bit early, decline, peaking more towards the middle, decline. So during this rising phase, we peaked a bit early. There could be a bit left here in the rising phase, but the next big move based on the time cycle is to the downside here for the 10-year yield. Given that there's a strong negative correlation between the agency bond ETF and the 10-year yield, it means that if the 10-year yield were to have a major declining phase going down, that would then likely be positive for the agency bonds, meaning bullish. So interesting time cycles and very clean time cycles. And we have seen a very substantial move, and we have also approached a level that has triggered prior pullbacks. Looking at the RSI and the MACD and the PPOs, we reached a very extreme level. Looking at the daily data points here, yeah, basically a very similar message. There have been a few times where we were even higher, but this is a level that has a strong tendency to trigger pullbacks. Well, this is actually the monthly data points. Okay, so I mean, this is one of those weird things about investing.com, because you see here we go from minutes, hours, days, months, and then weeks. It makes more sense to go from days, weeks, then months. I mean, it's a very illogical order here, but okay. Looking at the daily data points, we do see here that we have seen some cool down here in the 10-year yield. RSI, MACD, and the PPOs have fallen back close to levels that have triggered some bounces in the past. Looking here at the daily data points, we did have a very ugly reversal candlestick here, though you went way up here and then you closed lower. Here is the relationship between the agency bond ETF and the 10-year yield. So we do see here that we recently fell back to a very low level in this this pair. You could certainly make the case that this looks very much there's something a bit double bottom-ish here. Looking here at the RSI, we also are bouncing from a level that has triggered some pretty meaningful periods of outperformance for the AGSAT in the past. As you see here, looking way back here on the RSI, there's something interesting about this level for sure. Looking at the daily data points, yeah, so here we do have some seasonality. So in green here over the last 5 years, it usually is a bit flattish, but then the agency bonds start to underperform after July. Specifically here beginning 18th of July to just go down. In blue here over the last 7 years, we usually see some slight outperformance towards early July, then underperformance. And then in red here over the last 10 years, yeah, we see something similar. So yeah, that's the seasonality. Now I am comparing the AGG, the Diversified Bond ETF, with the S&P 500. So what is interesting now is that we are forming a very well-known pattern in the markets called, the rounding bottom. So we go from a period here of the bears dominating to some initial signs that maybe the bulls are going to have a stronger hand going forward. Given that these are weekly data points, it suggests that we could enter a period where bonds outperform stocks. So let's look a bit here at the seasonality, like that. Yeah. So over the last 10 years in red, the 7 years here in blue, and 5 years in green, we usually see that the bonds underperform stocks. That is, of course, what we typically see in a bull market for stocks. I think I will give the bulls a 3 here on relative performance. So we end up with an average score here of 3 in favor of the bulls. A key part of the bullish thesis is that given the data we have here on the technicals, seasonality, fundamentals, and relative performance, we certainly expect the 50-day moving average to hold as a support. If the bulls are not able to protect it, to attract more buyers at that level, that will simply just be a bad sign. Whatever you do, of course, you do want to use stops, be market neutral, and let the trend be your friend.